What's up, everybody? Today I'm going to be going over targets in price and draws on liquidity. In this video I'm going to be going over the targets that I use mostly when I'm looking for places to take profit, and areas that I just look for during my trading sessions. So why do we use them? We use these targets and draws on liquidity to set take profit points during trades and the spot areas that price might be targeting. So for example, if you're entering a trade, you don't know where to set your take profit. Take profit is basically where you think price is going to go to, and overall the area that price is targeting, where you're setting your profit point, if that makes sense. Anyways, so now we're going to be going over all the best targets that I mostly use. Okay, so here are the best targets that I normally use. We're going to be going over each and every single one of them in this video. Looking at them all quickly, we have equal highs and lows, low resistance liquidity, previous day highs, previous day lows. Don't let the abbreviations confuse you. PDH, previous day high, PDL, previous day low. Then we have new day opening gap, new week opening gap, London and Asia highs and lows, data highs and lows, and highs or lows inside of high time frame fair value gaps. So looking straight at this, the one that I most normally use is highs or lows inside of high time frame fair value gaps. That's the one that I look for most often, but you don't always have those. You have to look for other ones. It honestly just depends on the day. Honestly depends how price has been, but these are all targets that you can look for during your trading sessions. Okay, so we're going to be going all these in order. So starting off, equal highs and lows. So what are equal highs and lows? It's pretty much what it sounds like. It's basically when we make a high, trade a little lower, and then we make another high at the exact same spot as the last high. Now, equal lows. Same thing, but opposite. We make a low, trade a little higher, make another low at the exact same spot. Now, don't let this confuse you. It doesn't have to be, we don't need to make go higher and then make another low right away. It can look something like this. If we're looking for equal highs, it can look something like this. We make a high, trade down, trading in random directions, and then make another high at that spot. Those are equal highs and can be used as targets. Same thing with the lows. So that's an easy one. Equal highs and lows. Now let's go over an actual example. Took me a while to find this, but here you can see we have equal highs. We created two highs at the exact same level. I don't know if I marked it right. Yeah, there we go. So we created a high up here, traced a little lower, created another high. In this case, we didn't trade back to this point immediately. As you can see, later on we did end up trading just over these equal highs. Looking here, we have equal lows. Created a low, retraced a little up, traded back to that low, and that wick got to the exact same spot as the other low. Now, we did retrace back into this the next day, and we created a new day opening gap, which we'll get into later. As you can see, these equal lows, equal highs, pretty simple. This one wasn't exact, but I just wanted to find an example. But as you can see, they're pretty easy to spot out and can be used as target points. All right, we went over equal highs and lows. Now we're going to go over low resistance liquidity. So I don't know if you guys know about liquidity pools yet, all these draws on liquidity, but low resistance liquidity will look something like this. So basically, what's going on here is that we're creating all these lows. We're in an uptrend. We're creating all these lows, but we're failing to sweep the last lows, the previous low. So all these lows are just failing swings because they're not taking the most recent low. This low didn't take this low, this low didn't take this low, and so on. So what can this mean? This can mean that since we didn't take these lows after creating this trend line, price may want to retrace and take all those lows. See how that makes sense? Because since we didn't sweep those lows during the uptrend, if we're seeing signs of a retracement, then those can be signs that we want to take those lows. You can target all these lows. So another pretty simple one, mostly during uptrends, creating new lows, creating new highs. The lows are failing to sweep the most previous lows, which is why we have that being a target point. Since we didn't sweep those lows previously during the uptrend, we may want to sweep all of them now during a retracement. Let's try and find an actual example of that now in the charts. So now looking at an in-chart example of low resistance liquidity, we can see here that we were in an uptrend creating new lows, higher highs, and higher lows. We had a low here, 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 and so on. Now, none of the upcoming lows swept the previous low until here, until we had a retrace. Now, you can see that even this low, even though it was a much larger low, it didn't sweep this low. But after retracing a little higher, we ended up taking all those lows all the way up to here, which is why low resistance liquidity can be used as a very strong target point. Moving on, we have another very simple target. Previous day highs and previous day lows. PDH, PDL. PDH, previous day high. PDL, previous day low. So what does this mean? This one is arguably the most easy to find. All you have to do is go on the charts, go on the 1 day time frame, and so we just look at the previous candle, previous day high. So previous day, which is the previous candle, if you're on the daily time frame, that's the previous candle, and it's just the high of that candle. So that would be right here. Previous day low, it's just the low of that previous candle right here. Really simple. You just scale to the daily time frame, you look at the previous candle from the day before, yesterday, and you just mark out the highs and lows on that candle. Very easy, and it's a very good target for short-term trades. So going over it real quickly again, this is our current day candle, and we look at yesterday's candle, previous day high, previous day low. We look at the previous candle from yesterday, which is this one right here that I'm pointing at right now, and we just mark out the high of that candle and we mark out the low of that candle. Really simple. Next up, we have NDOGs and NWOGs. This stands for new day opening gaps and new week opening gaps. This is another really easy one to find in your charts, mostly because it's just a very random gap, and I'll show that right now. So what is a new day opening gap? Here we can see that we created a gap. There was a gap right here. So this was going into the new day. We created this gap. I'll mark it out for us right now so it's easier to spot out. That would be our gap. So this is used as a very good target point. In this case there were no buying orders, and it was just a big move down, and price very commonly likes to retrace back into that target point, and it's normally within the span of the next day, next hour. Sometimes it's mostly recent, or mostly doesn't take too long to retrace back into. In this case, you can see that we inversed that gap and we traded higher. Here we have another one. Where was it? We had a new day opening gap right here. We traded back into that gap and we retraced out of it. So these are very easy to spot because they're very random gaps like that. You see, normally the next candle opens right where the last one closes, but this is just a very random gap during transitions to next days, and like we're going to go over now, into next weeks. Now looking at new week opening gaps. This is the same thing except transition from week to week instead of day to day. This, since it's a higher time frame, holds higher power. So as you can see, transition to another week, we had this big gap right here that we retraced back into and traded out of it, going higher. Again, easy to find. It's a very random gap transitioning from week to week that you can spot out very easily. And price very commonly likes to trade back into this gap since higher time frames hold higher powers. And if it's a new week opening gap, there is very high probability that we retrace back into that gap and either trade out of it or inverse it. Okay, next up we have London and Asia highs and lows. This one is another very easy one to spot out, especially if you have the session indicator, which I don't have turned on right now. But the way I'm going to be going over it is I'm just going to be showing you guys overnight lows and highs, which is overnight, I mean by Asia and London. So right here you can see that overnight we had a very high, or we trade very high, and this is a very significant draw on liquidity. I'll explain why when we get to the highs inside of fair value gaps, but let me just mark this out for you guys. The shaded blue area is any other session other than New York and AM session. So in the shaded blue area we created a high, and in this case we haven't traded back into it yet, but I do think that we're going to trade into it very soon, hopefully tomorrow if there's long opportunities. And so that's another very simple target, just in the shaded blue area, especially easy if you have the London and Asia high indicators on. And another one would be right here. We had this low These are just very easy to spot out. In the shaded blue area, we have the significant low. Just marking these out. Just want to show you guys. Moving on, we have data highs and lows. What are data highs and lows? Data highs and lows are basically when we have high impact data, news data, such as CPI, PPI, when we have big moves up or down in the market, and we create highs or lows from those candles. So the example that I'm going to be going over today is CPI news data. CPI news data happens once a month, and it's a very high impact news just data that happens once a month, and many people like to pass evals on it. And basically what it is that at 8:30 Central Time, 7:30 Central Time, sorry, there is just a big either move up or move down. One candle, either big move up, big move down. And I'm going to be going over that now. Okay, so I wasn't able to go all the way back on TradingView to show you guys previous CPI days because the last CPI day actually failed. Well, didn't fail. Forget it. I'm on FX Replay right now. I'm going to previous time data. And so right now on February 13th, 2026, and the minute right before CPI came out, and we're going to be going over it right now so I can explain to you guys what actually happens. So we're on the 1 minute time frame right now. As you can see now, there's going to be a big candle, yeah, you see that? Huge candle. I'm on the 1 minute time frame, so this candle happened in 1 minute. So this is because this is at 7:30 Central Time, so this is when CPI news data came out. Well, again, once a month, comes out at 7:30 a.m. Central Time. It's a big candle that is commonly used to pass evals. It's a high impact news data, and basically what we do is we wait for that candle to come out, or when it does come out, we just mark in this case, the high of this candle. So it's one candle, so we just mark the high of that candle. Since this was the news data candle, this is the top of the wick of the news candle. So we mark out that high of that candle, and then we can use that in upcoming trades. Anyways, there you have it. So anyways, going over it real quickly again, it's a high impact news candle that comes out once a month, and you can figure out when this is coming out by checking on Forex Factory. And basically, after this candle comes out, we mark the high or low of this candle's wick, and then we can use that to target in our upcoming trades and use that as take profit points. Last target that we're going to be going over, and the one that I usually most happy to find, and the one that works most often for me, is highs or lows inside of high time frame fair value gaps. So what is a high or low inside of a high time frame fair value gap? Let me draw it out for us real quickly first. Okay, so let's say we had this big move down, and in this move down we created a bearish fair value gap. Let's say this is the fair value gap. Okay, after creating that bearish fair value gap, we trade around a bit, random directions, consolidating, whatever. Then we create a high inside of that fair value gap, and let's just say it's a wick. It's the wick of that candle that creates a high inside of that fair value gap. So after we see that high inside of fair value gap, we mark out that high to target later on. So now we see a setup we like, and we use that as our take profit point, and price trades all the way back up there. Now let's find an actual example on the charts. Okay, so I take back saying that it has to be on the high or low has to be in high time frame fair value gaps. Oh my gosh, fair value gaps. It can be on lower time fair value gaps too, such as 5 minute, 15 minute, those. And now there's a really good example on the 4 hour. So this is a high time frame fair value gaps, and draws on liquidity I just think are more likely to get hit. And so anyways, as we can see, similar to the example I showed, we have a 4 hour fair value gap right here. 4 hour bearish fair value gap. Then we create a high inside of this fair value gap. So as you can see, the wick of this candle right here got inside of this fair value gap, which creates a high inside of a fair value gap. So I mark this high out, and there's another one here, I'm pretty sure it's below. Anyways, and then I mark those out, and we haven't hit those yet, but those are still draws on liquidity that I think are eventually going to get hit. Now, I know I said high time frame fair value gaps, but it doesn't have to just be high time frame fair value gaps. Even here today on the 5-minute time frame, you can see that very similar situation. We created a bearish fair value gap here, and then we created a high inside of that fair value gap, which can be used as a draw on liquidity for longs tomorrow, and so on. Now let's try and find a bearish example. Now looking at a low inside of a fair value gap example. Still on the 5-minute, we created a bullish fair value gap right here, then traded back down into that fair value gap, formed a low inside of that, and marked that out. Can be used as a draw on liquidity. Now this one is a little more sketchy since the body of that candle closed inside the fair value gap. I prefer to see just the wick go into that fair value gap, but anyways, still created a low inside of a fair value gap, 5-minute fair value gap, which can be used as a significant draw on liquidity. This is the one that I prefer to use most often, mostly because when I see that, you can also target just fair value gaps, and when I see a high or low inside of a fair value gap, it just gives me extra confirmation, which we always like to see because it's higher probability. Now that we went over all of these targets, hopefully you have a much better understanding of each one of these. These are a little more advanced, and hopefully you were taking notes on them so that you can look back into them during your trading sessions to know what to look for and to know where to set your take profits and what to target overall during your trading sessions. We went over equal highs and lows, low resistance liquidity, previous day highs, previous day lows, new day opening gaps, new week opening gaps, London and Asia highs and lows, data highs and lows, and highs or lows inside of, let's change this, fair value gaps. So, as I said, I like to see mostly highs or lows inside of fair value gaps, but we don't decide market decides. You don't control the market. You just kind of have to adapt to whatever you see. These are all very good targets to scout out for during your trading sessions, and targets that usually get traded back into. Now, there really shouldn't be a favorite one of these because no matter what, all of them are going to form, and all of them have a pretty good probability of getting traded back into. That's why they're good targets, and that's why they're targets that I look for. If you didn't understand any of these targets or anything specifically, feel free to comment below any questions you may have, and I can either one-on-one explain it to you, make a whole nother video on specifically that target, but please let me know if you guys have any questions on any of these targets. Thank you guys for watching this video, and hopefully overall you guys have a much better understanding on the best targets that you should look for during your trading sessions and before, and overall highs and lows, and just areas that you should look for price to get traded back into and mark out as draws on liquidity. Thank you guys for watching. Make sure to comment if you guys have any questions, and make sure to check out my other videos. Thank you.